Welcome to the InterMarket Analysis video update. This is a video that I do once a week, and even though it's a standalone video, it's not necessarily meant to be used alone. There are other videos that I post. I do a video each day. I also have a weekly video, and then after this, I have what I call the deep dive video. And taken all together, the idea is to give us some pretty good insight as to what's happening in the market. Intermarket analysis looks outside of the stock market and outside of the S&P 500 as an index because no index or even stock for that matter exists in a vacuum. And sometimes by looking at other markets, that can give us some insight as to what's happening in the S&P 500. This is being prepared for Monday, September 25th. The first area that we look at is a thing called S&P 500 valuation. We look back historically to see, okay, what were valuations compared to prices looking backwards. That can help us to get some insight as to where things are at right now. But the market doesn't do that. They look forward. And so we also look at forward projections as to what earnings will be. And that can also give us some insight as to where we're at right now. The first chart that we look at is the PE chart. And we have a PE of 10, 15, and 20. Also on this same chart is the S&P 500. Right now, we're above the PE ratio of 20, which is the red dashed line. That's suggesting that on a historical basis, we are considered to be expensive. And then on the bottom, I have the spread between the current price of the S&P and the PE ratio of 20. When we're above zero, that means we are expensive. We don't necessarily use this to make decisions. It just gives us an overall feeling for, okay, is the market overvalued, undervalued? And then longer term, that can feed over into some technical features that we actually end up using. We can also look at this based on historical events going back to 1980. We have the 1987 crash, the dot-com boom and bust, the housing crisis, and then, of course, the whole COVID plunge, and then where we're at over on the right-hand side right now. We also look at another variation of looking backwards with the Shiller PE ratio. This looks at a more smooth average over a period of time to see where are we as far as valuation. Right now, we're getting a reading of 29.7. Well, to give you some context, we can look at the chart here. We were just a little bit above this right now when we had the 1929 stock market crash. You can also see where things were at back in 1987. To look at this on a number basis, we look at the median and the mean, and that's between 16 and 17 historically. So the market is still considered to be overvalued at this point. But the market doesn't do that. They look forward. Based on analyst projections and forecasts and things like that, every day we get the PE ratio looking forward that updates. And currently, as of the 22nd, the S&P 500 is coming in at 18. So we're under that 20 level, but we're above the 15 level. We also look at the mid caps, which is coming in at 13.1, and we're coming down pretty significantly with the small caps coming in at 12.6. These stocks have been under a lot of pressure lately. We put all of this together on one chart just to give us a little bit of a graphical representation. And as the S&P has been going down lately, we're seeing the PE ratios also coming down. Then we also look at the small caps, which again have been under a lot of pressure. And there are two main indexes that we follow, the S&P 600, and that's the blue line here. And that matches up with the 10, 15, 20 scale. Well, there's also the Russell 2000 small cap index, and that is calculated a little bit differently. So we're getting a different PE ratio for that one. I mainly follow the blue one just to get some perspective as to where we're at right now. We also look at growth versus value. Growth is when the market's really going up. You want to buy low and sell high. Value are stocks that tend to hold up better when the market's running into some problems. Looking at just a growth index by itself, we crossed over in the latter part of August and gave a golden cross here. So growth is showing some improvement. We're seeing some weakness in value, and this is still in an overall downtrend. Where this is really helpful is when we compare the two. We take some ratios. We have a growth to value ratio on the top showing that growth is outperforming value, and then we have an inverse of that same chart showing how value is underperforming growth. One of the reasons I use lots of different charts is you can see where the cross here was slightly delayed. They didn't happen at exactly the same time. The different measurements that we use, like ETFs or indexes, these can sometimes vary a little bit. And so we get different answers, and we just want to see a confirmation across the board. We look at an ETF of growth versus value, showing how growth is outperforming. Here's an inverse showing how value is underperforming. And then we look at another index measurement where we're seeing that growth is outperforming value, even though it's seeing some recent weakness. And then value is underperforming growth and seeing some strength lately. And then the last chart with this particular focus is we're seeing that growth is continuing to outperform value. We look at some other measurements of growth versus value where we're pulling back right now when we look at growth, but we're still in an overall uptrend longer term. And value continues to be in a downtrend longer term, even though it's been bouncing back up lately. We look at small cap growth and compare it to small cap value, where we're chopping more or less sideways, but we're still in a longer term uptrend. Mid cap growth versus mid cap value, kind of the same thing. It's been a little stronger throughout 2023, but we're chopping more or less sideways now, especially since the market is hitting some difficult times. This is the one that we really focus on for the S&P 500, a growth to value ratio end of day chart, where again, we're chopping more or less sideways. We did bounce up in Friday's session, but as the market's been under pressure, that's putting growth under pressure as well. We also keep an eye on inflation. We have a monthly chart of the CRB index where we're starting to turn back positive. And so folks are a little bit concerned about that. So what we look at on the bottom is an inflation to deflation ratio. And this is continuing to go down, meaning that according to this, inflation is not really rising at this time. We look at the CRB index by itself, where for a lot of 2022 and into 2023, it was in a downtrend. It's recently had the golden cross and is now in an uptrend. Then we look at the Baltic Dry Index, the cost to ship things from one place to another, specifically in the Baltics. This is really starting to spike back up, but it's continuing to be in a longer-term downtrend. Some other markets that we don't really watch all that close, but it's good to keep an eye on these about once a week or so. We have aluminum, which is in a downtrend, corn, which is in a downtrend, wheat, also in a downtrend, fertilizer, which is coming back up, but is still in a longer-term downtrend. Oil, that's kind of been at the forefront these days. Saudi Arabia and Russia decided earlier in 2023 that they were going to cut back on production. Well, they came out a few weeks ago and said, well, we're going to extend that through the end of 2023 at least. And that has been really pushing oil prices back up, which feeds over into the other markets that we need to also keep an eye on, such as gas. And this is now in an uptrend. And you're probably feeling that every time you fill up your car or truck. We look at diesel because there's a lot of the railroads and trucks and things like that that use diesel, where it had been declining, but now it's starting to go back up. This could be inflationary. Heating oil, now that it's starting to get a little bit cooler, this is starting to come back up, and we're seeing the beginnings of an uptrend. And natural gas also is still in a downtrend, but it has been bouncing back up. We look at copper because this is used as a barometer for the economy. When copper's going up, the future tends to look brighter for the economy. When it's going down, things tend to look weaker. We've been chopping sideways quite a bit lately, but we are in a downtrend on the daily chart of copper. We look at copper again and then compare it to gold. When the economy's doing well, copper tends to go up and gold tends to go down. So we keep a ratio chart here where we're pretty much chopping sideways. Gold has been under a lot of pressure lately, even though some inflationary pressures are coming back into the market. We look at a longer term version of that same chart, and we also plot the 2-year yield and the 10-year yield. The black line is the copper to gold ratio, where it's pretty much been declining as we're seeing interest rates going up. If you look historically, these have a tendency to move in the same general direction and not to get too far apart from each other, even though they're on different scales. Well, we've been watching this for about a year now, where this is not really lining up all that well as the economy has been shifting. We look at gold, which is kind of in danger of seeing a death cross here, but it's still in a longer term uptrend. It's been really choppy. And silver has also been pretty choppy. We're still in a longer term uptrend, but if we fall, this could generate a death cross. Then we look at gold on a closing basis on the top. In the middle is silver, and we look at the correlation between the two. They have a pretty strong tendency to go in the same direction at the same time, even though that's been weakening a little bit lately. Then we have a study that we look at just to get some perspective. We have the gold to silver ratio on top. So when this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. Now, both gold or silver could be in an up or downtrend. We're just seeing which one is doing better. And then in the middle part, we have an observation that we've made that says when the US dollar index goes up, which is what's plotted here, gold outperforms silver. When the index is going down, silver outperforms gold. And we're seeing this going up. That is that gold is now outperforming silver. And then we can see that there's a pretty strong correlation between the two on the bottom. The dollar's been really strong. Gold is still in an uptrend, but pulling back. And that's why we're seeing this ratio going up. We look at the dollar index. This is switching over now. It had been in a death cross going in a downtrend. We're starting to see a golden cross here as the dollar has been seeing a real rebound lately up into the 105 region. And this has also been what's putting pressure on stocks. We look at it compared to other currencies throughout the world where the euro has been solid against the dollar. Now we're seeing the euro show some weakness. We also see the Japanese yen, which has been declining when compared to the dollar. Here's a standalone chart showing how the Japanese yen is underperforming the dollar. And the British pound is still in an uptrend, but we're seeing a lot of weakness right now as the dollar's been showing some strength. We look at some indexes. We compare the S&P 500 regular index, which is weighted, with an unweighted or equal weighted version of the S&P 500. And the equal weight index is underperforming. That means the broad market is weaker, but both have been under pressure lately. We look at the S&P 500 and compare it with the CRB index, where stocks have been going down and commodities have been going up. Even though we're still in a longer-term uptrend, we are seeing some weakness. And then we have an inversion of that same chart where we're seeing some recent strength in the CRB index compared to the S&P. We look at the NASDAQ 100 and compare it to the S&P 500. Now, they're both doing fairly well in 2023, even though the month of September has been rather difficult. And the NASDAQ 100 is still continuing to outperform the S&P. We look at the S&P 100, the biggest stocks in the S&P 500, and even though there's been some weakness here, the bigger stocks are outperforming the rest of the S&P. We look at the NASDAQ, which has done quite well in 2023, and compare it with the S&P, which has also done well, and it continues to outperform. When we look at the NASDAQ, even though both have been doing okay, the NASDAQ 100 continues to outperform the NASDAQ, even though this past week was pretty rough. We look at the mega cap, the really, really big companies, and compare it with the equal weight index, showing that the equal weight stocks are underperforming or the mega caps are really outperforming. And when we compare small caps, which have been under a lot of pressure, we're seeing this ratio, which is the red line, really going down. If things were to turn more positive, we want to see this red line going up. And then we compare that to the blue line, which is the S&P 500. We look at the ratio between the small caps and the S&P, showing that the small caps continue to really underperform. And this has to do a bit with the rising interest rate environment. These are smaller companies, and often they have to borrow more. And when they have to borrow more at higher interest rates, that's going to feed into their earnings results. We look at the biggest software companies, still in an uptrend, but showing some recent weakness. And you're going to hear that same basic theme as I go through these different charts. The mega caps also shorter term weakness, but still in a pretty solid uptrend. We're looking at the robotics and AI ETF. That's all the rage right now, where it has really seen some difficult times in about July. It topped out and has been coming down. Where it's even weaker is when we compare it to the tech sector, and it's really underperforming. We look at the Dow Jones Composite Average, which is the Dow, the transports and utilities, and put together as a composite. We're still in a longer-term uptrend, but we have been seeing some weakness going back to the latter part of July. We look at the S&P and compare it with shorter-term bonds based on price, where the S&P is underperforming in the short term, but longer term, it's continuing to outperform short-term bonds. We look at a broad market measure to take all stocks or all the stocks in this particular measurement and then compare it with further out bonds, and they continue to outperform even though they've been underperforming in the short term. We look at the low volatility ETF, which just crossed over negative and is now showing a death cross and is beginning to go in a downtrend, even though when the market starts to hit difficult times, this tends to perform better. And we're seeing this on the ratio where we came down, and you could say we might have hit some kind of a double bottom here, and we're bouncing back up slightly. We're going to be watching this to see, because when this was really going up, that was the difficult time that we hit in 2022. If this continues to go up, are we going to see something more like what we saw last year? We look at the tech sector and compare it with bonds. Longer term, tech is outperforming. Shorter term, it's underperforming. And then we compare the S&P with other stocks. We look at an advanced decline line study, and this looks at a lot of different indexes. We take just the common stock on the NYSE, where we're seeing weakness, also weakness with the S&P and the mid caps, and we're seeing even more weakness with the small caps. We look at Dow Theory based on the traditional idea that you compare the Dow with the transports, and they're both declining right now, but we're seeing transports going down a little bit stronger. I also include utilities here in this study, and they're continuing to decline, which often can be supportive of the S&P 500, but it's not really helping right now. We look at the transports and take a ratio to the S&P. When this is going up, that means the transports are outperforming. When it's going down, that means that the S&P is outperforming. And this has been going back up. So we're seeing a little bit of an improvement here, but we want to see this continue to go up to really put some strength into the market. We do a ratio between the Dow and the transports. When this is going up, the Dow is outperforming. When this is going down, the transports are outperforming. And it's been bouncing back up with this ratio, showing that the Dow's been doing better. And we've been chopping more or less sideways over the last few days. We look at the relationship between the S&P and the transports and showing that it's still fairly strong. They have a pretty solid tendency to go in the same direction. Then we look at a new idea behind Dow Theory, where instead of using the Dow, we use the S&P, since that's a better representation of the U.S. economy. And instead of using the transports, which at the time it was created meant railroad stocks, we look at the NASDAQ because that's more tech laden. And they're both seeing some weakness right now. We're not really seeing anything that's causing a real concern. They're both going down. We try to look for positive or negative divergences in this study. The FANG index, which is still in a longer term uptrend, but we're seeing some weakness as it dropped below its 50-day moving average. And then longer term, we came up earlier in the summer, we did set a new all-time high with the FANG index, but then we've been bouncing back down since that time and seeing some weakness currently. ARC, which did have a recent golden cross, has now been seeing some weakness, and it's coming back down to its 200-day moving average. Then we look at a broader measure. This is a monthly chart of the S&P 500 on the top, and we compare it with stocks in Europe, Australia, Asia, and the Far East. And we're still showing that longer term, the uptrend is still intact, even though it's been coming down lately. To get an idea of what direction we're moving, we look at the percentage price oscillator, or PPO, and it's continuing to advance above zero, even though it's rolling over slightly. Then we compare stocks with bonds. The total bond ETF, it's going down now. This is bonds based on price. As price goes down, that means interest rates are going up. We also look at world bonds, which are in a downtrend and have been declining lately. We compare stocks with bonds and take a ratio of that and look at it on a monthly chart, showing how stocks are outperforming. And then this also is an inverse, where we're seeing shorter term bonds underperforming stocks. We look at high yield bonds, which means junk bonds, and they continue to hold up quite well and are in a pretty solid uptrend. Then we look at investment grade bonds, which are more conservative, and they're starting to see a downtrend. We look at a ratio between riskier bonds and more conservative bonds, and this is continuing to go up. Folks tend to prefer high yield bonds, even though they're willing to take on more risk because they're getting a better return. Then we do a correlation. And right now, it looks like stocks and bonds are going in the same overall directions. Stocks have been under pressure and bond prices have been under pressure. And so we're seeing this correlation pretty strong. Then we look at the Dow Jones Corporate Bond Index, which did generate a recent death cross as it's been chopping more or less sideways. We look at the 10-year yield, which is starting to break out, and this is causing concern in the markets. We're getting up into pretty high levels that can impact earnings for stocks, and that's been putting some pressure on prices. Then longer term, we go all the way back to 1980, where for about 40 years, we saw a series of lower highs and lower lows as interest rates kept coming down. Are we starting to see a shift here as interest rates are going back up, which this would be more of the old normal? Before we hit this 40-year period, we typically were in environments where interest rates had been higher, and we're wondering if that's starting to go back to that way of interest rates having more of an impact. We look at the 30-year yield. We're still above the 61.8% retracement level and going up overall with the yield. And then we look at the performance of the S&P 500 and compare it with interest rates for the 10-year, where we have crossed back below, showing that stocks are now underperforming the rise in interest rates. We look at the junk bond ETF, which continues to be in an uptrend. Then we compare that with government bonds, showing that junk bonds are really outperforming. Then we look at bonds based on price, where we've seen a recent death cross. The RSI is negative, even though it's turning back up, and the MACD continues to be negative. So based on price, bonds are under pressure. Then we look at a daily chart of yields, showing how rates have been really going up, even though we have a lot of inverted yield curves currently. But we've been in that situation for quite a while. This is interesting. Where the UK had the highest interest rates, we saw a shift as the US is now coming back up and the UK is coming down. So now the US is back in the lead, having the highest yields. And then we're seeing an increase in Germany and also a little bit of an increase in Japan. We look at the MOVE index, which measures the volatility of bonds, and it's been going up slightly. But where we really saw an increase is with the VIX, which measures the volatility of stocks. The correlation is not really strong right now as stocks have been under pressure. And even though bonds have been going down, it hasn't had much of an impact on the MOVE index. We look at a long-term monthly chart of the price of bonds, which are in a longer-term downtrend. But when you compare that to the CRB index, the price of bonds is continuing to outperform, but this is rolling over. We'll keep an eye on this one. Then we look at different sectors in the S&P, where the materials are in a downtrend compared to a ratio of the S&P. Communication is still in an uptrend. The energy sector, which has been in a longer-term downtrend, has really been surging back lately, but not enough yet to generate a golden cross with this ratio. The financials, which got hit back in March, have pretty much been floating sideways since then. The industrials are also in a longer-term downtrend. Tech, which still is outperforming the S&P and is still in an uptrend. Staples, which are seeing some weakness and are in a downtrend. Real estate, which is really getting hit hard in 2023, it's in a pretty solid downtrend. And utilities bouncing back recently, but still in a longer-term downtrend. Then we take a ratio between the S&P and utilities, and when this is going up, that often gives good support to the S&P. We saw that through August and into September, but it really didn't help all that much. This ratio is now starting to come back down, and we're looking at this more in a negative way. If this continues to fall, that could add some more pressure to the S&P. Healthcare is also in a longer-term downtrend. Here's another chart showing healthcare is weaker than the S&P. Discretionary, which has been one of the better areas in 2023, lately it's been seeing some weakness, but it's outperforming the S&P. The staples sector is also crossing over negative. This had pretty much chopped sideways through a lot of 2022 and into 2023, but it was maintaining an uptrend. Now we're starting to cross over and see a downtrend. We look at the tech sector, which is still in a solid uptrend, but we are seeing some recent weakness. The semiconductor, same thing, recent weakness, longer-term uptrend. And when we compare the tech sector with the S&P, we're seeing some weakness here, but still it's in a longer-term uptrend. We look at the energy sector and compare it with the tech sector, where energy has been underperforming, but seeing some recent strength lately. We look at growth areas, and they are outperforming the rise in bond prices. So this is still in a pretty solid uptrend. We'll look at the tech sector and compare it with the 10-year yield, showing that the tech sector is seeing some recent weakness here comparatively, but it's still in an uptrend. Here's an inverse of that same chart. Now, if this continues, this might actually cross over and give us a golden cross, showing that the rise in interest rates are outperforming tech. We look at discretionary versus staples. This is another way of looking at growth versus value, where even though discretionary has been underperforming lately, longer term, it's still outperforming. And then this is an inverse of that same chart, how staples have been underperforming, but seeing some recent strength. We compare gold to the S&P, which is really underperforming, but it's shot back up as the S&P has been going down. And we look at gold to the dollar, where the dollar's really been outperforming gold. And high leverage loans, which I always say in the video, if we were getting ready to fall off a cliff economically, would this be going up as strong as it is? Probably not. And this has been happening for quite a while now. So this is giving us a little bit more confidence about the economy. We look at the NYSE composite, which has been chopping more or less sideways, but it's still in an uptrend. All stocks, recent weakness, but still in an uptrend. Emerging markets, pretty much chopping sideways, still in a tentative uptrend. And in microcaps, we are keeping an eye on this. The small caps have been under pressure. The microcaps, which are even smaller, they've also been under pressure. We're still above 100 for right now. We're going to be watching this to see if we drop below 100, and this is in a downtrend. Then we look at the housing ETF and the home builders, where this has been holding up fairly well in 2023. Right now, it's just following what the overall market is doing, and the relationship between the two is still pretty strong. Bitcoin, which just had a recent death cross on the daily chart, and it's kind of strange. Once we saw a golden cross here, then we see weakness in Bitcoin. Here, we see a death cross, and we've seen some recent strength, even though now it's starting to come back down. Then looking internationally, where China is now rolling over, emerging markets, Europe is still in a pretty solid uptrend, where Japan's going sideways. We're rolling over a bit with the S&P in the US. Then looking at the intermarket analysis chart, going back to the beginning of the year, stocks have been performing the best, but now we're seeing a real surge in oil. So oil is now in the lead, followed by stocks. Then we have the dollar and gold, where bonds went negative in the early part of August, even though they bounced up a little bit on Friday. We look at some correlations to see if this gives us any insight. Right now, we're seeing that the S&P 500 and the dollar are going in opposite directions of each other. And we look at S&P to oil, where this is pretty much neutral. Now, as I've been trying to explain, there can be times when oil goes up and stocks also go up. That has to do more with earnings and a more positive environment. The rise in oil right now is more inflationary, and that's why the market is pretty fixated on this at the current time. Then we look at the S&P 500 and compare it with the 10-year yield. They're having a pretty strong tendency to go in opposite directions. And then we look at the tech sector to the 10-year yield, and they're also going in opposite directions. We look at a shorter term here by looking at the 2-year yield, where they're also having a tendency to go in opposite directions when compared to the S&P. Then we have some long-term secular, which can be decades, and cyclical, which usually means years, trend studies, where we have a monthly chart of the NYSE. And even though it's seeing some weakness here, it's still in a longer-term uptrend. We look at the Kopic curve to measure the momentum, and it's continuing to be positive. And then we have a daily chart of the NYSE, and we look at the NYSE record high percent index, where it's been bouncing up even though we're seeing some recent weakness. And then we look at the S&P and compare it with the PPO, where it's rolling over slightly. So this is a little bit of a concern. But when we look above, we're still above this moving average, even though we have been declining. Then we compare the S&P to the CRB index, where the S&P is outperforming, even though the CRB has been seeing some recent strength. We look at the S&P and compare it with a global index, where we're continuing to be up overall. And this KST is kind of, I don't know if that's just really helping us or not. We can clearly see that the S&P is outperforming global stocks, but this is saying that we're in a downtrend. So then at the end, I take all of the things that are positive and then make a list, and then I have a negative list. And my definition of positive is when the 50-period simple moving average is above its 200-period simple moving average. I know there's a lot of different ways to measure positive and negative. This is just giving us a general feel as to what's happening. So we have the growth indexes, which are positive, the CRB index, the big software companies, the dollar, which that's a new addition to the list, the euro and the British pound, even though they're showing some weakness, They're still in longer term uptrends compared to the dollar. Gold and silver, which might be getting close to a death cross if we see follow through weakness. The mega caps, the Dow Jones Composite Average, the FANG Index, also ARC, bonds, which we're talking about high yield and junk bonds. Those are still in uptrends. The tech sector and the semiconductors, high leverage loans, the Dow, the mid caps, and the small caps, even though small caps have been under pressure, they still have a longer term golden cross that we're working off of. The NASDAQ and NASDAQ 100, the NYSE composite, all stocks, emerging markets. And then on the negative side, this is when the 50-day simple moving average goes below the 200-period simple moving average. This is the value indexes that we've been following, and they're seeing some weakness. Copper is also in a downtrend. The Japanese yen to the US dollar, the low volatility ETF, that is a new addition to the negative list. Staples, also a new addition. The total bond ETF and the world bond that we follow index. And then the micro caps are also in a downtrend. The investment grade bonds, which are more conservative, as well as corporate bonds. And then the Bitcoin index is now dropped back after generating a death cross. So thank you. I hope you found this helpful. Please feel free to check out some of the other videos to get a bigger picture view of what's happening. I hope you have a really good weekend, and I will talk to you in the next video.